Microsoft has posted its earnings and a double beat, yet the share price is down around 1.5%. So what price is Microsoft a buy now? We're going to take a look at the historical performance of the company. We'll see how their top line revenues progressed over the last few years, as well as their bottom line net income. We'll have a quick look at one of the best balance sheets in the world, their total cash versus their total debt. We'll also see how they're performing versus not only the industry but some of their peers over the last 5 years. We'll also discuss that dividend safety, looking at some of the financial metrics to see how strong this company really is. We'll see what the institutions are doing over the more recent quarter. Have they been buying? Have they been selling? And we'll also discuss some of the insider selling that we have noted over the last few weeks. And more importantly, we will take a quick look at what they delivered just this morning in terms of those results. Now, in terms of the valuation, we will put them through the model, getting to the intrinsic value, seeing what our acceptable buy price is given that investor margin of safety, and we'll look to Wall Street to see what price target they have over the next 12 months. So let's jump straight into their earnings. Now, the headlines, we can see they do issue light guidance, even as the Azure growth drives an earnings beat. So let's take a look. Just a point here that during the quarter, they did finalize the acquisition of the game publisher Activision Blizzard in one of the largest deals ever. Now, in terms of the numbers, for those that like to see the actual performance, earnings $2.93 per share, analysts estimating $2.78, revenue $62 billion versus that $61.12 from Wall Street. So very, very strong, absolutely incredible by Microsoft. They seem to continually perform very, very well. And when we take a look at their revenue, well, we can see that their revenue increased 17.6% year over year in the quarter, which is absolutely phenomenal. So very, very strong performance. Now, one of those areas of the company that Wall Street did want to see was that growth from the Azure and cloud services. Well, that was up 30%. Analysts were expecting 27.7%. So very, very positive. So lots of good news with Microsoft. It seems like they can't do anything wrong. Over the last year, well, they are up 66%. Over the last 10 years, if you've been holding this company, you would be up an incredible 1,000%. And whilst it might not seem like a lot, this doesn't incorporate that dividend. So if you were reinvesting, this would be even higher. Now, granted, they are towards the upper end of the 52-week range. The yield is about 0.73% and the forward P is now sitting at 36. So let's take a look at their earnings. How well have they been performing? 126 billion reported in June 2019. Remember, we look for 3 to 7% as a mere basic level for growth. 2023, 212 billion. Absolutely incredible growth for Microsoft over the last 5 years. On top of that, very, very nice to see that consistent increasing to the top line year on year. We will very briefly look at the last 10 years percentage-wise too. In terms of the bottom line, 39 billion reported in 2019, 72 in 2023. So they've nearly doubled their bottom line. And again, consistent increases year on year, although we do see in 2022 to 2023 staying pretty much flat. Nonetheless, a very strong performance over the last 5 years on the bottom line as well as the top line. Quick health check then, total cash versus total debt. Interestingly, they had 134 billion worth of cash and short-term investments in 2019. Latest quarterly report, around 81 billion. Now, some of that will be due to the acquisition of Activision Blizzard that we mentioned earlier. Nonetheless, still a huge amount of cash and short-term investments to sit on the balance sheet. In terms of their total debt, numerically and directionally, we can see it has pretty much moved very, very minimally from 86 billion to 88 billion. Now, we will touch upon that dividend safety and net debt to EBITDA metrics, but pretty much they have the same level of cash that they do in terms of debt. In terms of looking at some competitors in the system software to see how the industry as a whole has performed, well, Microsoft itself, while you may think that's very, very strong at 67.5% growth over the last year, they are in fact one of the middle performing, as we see quite a few up triple digits. Now, when we extend that to the last 5 years, Microsoft, again, very similar, isn't one of the best performing, which may surprise you, up 306% We have other companies up 370, 758. Now, this is still a very strong performance over the last 5 years, but do not kid yourself. Just because they performed this well over the last 5 years, it doesn't necessarily indicate anything towards their future performance. Now, institutional ownership does sit at 69%, and as we can see, there were around 163 billion worth of sales by the institutions over the last 12 months. Probably for the first time in a while, actually less buying by the institutions. Still a lot, 156 billion over the same period, but actually less than, as we can see here, the selling. Now, notably, the largest sales were in Q2 of 108 billion, and as you will know, the share price rocketed even from that point as well. In the more recent period, Q4, institutions have bought more than sold, but overall, if you're looking at the last 12 months, institutions have sold slightly more than they've bought. In terms of buys and sells, well, insider selling, we do note 2 insider sellings over the last few weeks. Now, they sold around 13 to 14 million worth of shares between them, but as you can see, they sold for a much lower price. The share price is up nearly 10% from their sale. And for those new viewers, insider selling isn't really a bearish signal. There are many reasons why insiders sell, whether that is essentially for personal or financial reasons. Dividend safety score 99, it is very safe. Market cap 3 trillion, it is a mega cap company. In terms of those key recessionary metrics, well, they maintained the dividend in the last recession, around average growth, and also very marginally beat the S&P negative 48% versus the S&P's negative 55%. Dividend growth pretty consistent over the last 5 years, a 10% increase in September 23 and a 10% increase year on year on average over the last 5 years. Very strong 19% increase over the last 20 years. And for those that like to know, they have been increasing those dividends for the last 13 years. In terms of dividend yield theory, well, it should come as no surprise. We have an overvaluation signal. That yield is sitting below the 5-year average, as well as the forward PE 33 above the 5-year average of 30. But do bear in mind that we don't look at any of these models in isolation. In terms of the information technology sector at PE as well, it is sitting comfortably low at 24.6. Let's look at the free cash flow payout. Earnings is always susceptible to manipulation by management through accounting. My personal preference below 60%. Then we get to see those double-digit increases that Microsoft are well known for. In fact, over the more recent period, it hasn't even been above 40%. 2023 at 34%. Pretty much expected the same in 2024. So this year, I would expect another 10% dividend increase or similar. Free cash flow per share, well, very, very strong, more than 2 times growth over the period, 326 to 799, expected to be in the $9 region in 2024, so very positive to note. It isn't massively inconsistent either, which is also nice to see. Sales growth, nearly double-digit increase to their top line every single year. That is very, very positive. In fact, 2021, 2022 were very strong years at 18%. Total sales then have more than doubled over the period. They also do share buybacks. We love to see this, returning excess cash to investor pockets, 8.4 billion to 7.47. ROIC, remember, personally, I don't invest in companies that have this lower than 10%. I do use this metric to gauge management. If it is around that 10% level or more, it does give me faith that they are able to effectively allocate their capital. And we can see it is consistently very, very high. In fact, the last few years in the 30s. Operating margin, not only is it above that minimum 12%, it has in fact also been increasing, so their operating efficiency has improved, and the free cash flow margin in the mid-20s to low 30s also looking very strong and very healthy. Should come as no surprise for the net EBITDA, earnings before interest, tax, depreciation, amortization, which shows us the dividend safety and essential balance sheet strength. It is 0. It wouldn't even take them 1 day to pay off all of their debt net of cash on hand. So let's take a look at the valuation model. As always, if you enjoy the content values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, let's jump into the first model. This is Graham's valuation. Now, typically we use this for companies that don't have fast double-digit increases to their top line, so this is irrelevant for Microsoft. Jumping into the multiples valuation, companies in a similar sector and size, we have their average PE, which we multiply by the earnings per share of Microsoft. To get an intrinsic value, not that far off the current value. We do have that overvaluation signal though, as it is lower. But remember, we don't look at any of these models in isolation. We then have the dividend discount model with the yearly dividends, their growth rate looking very strong, double digits. Now forward looking, I've gone a bit more conservative at 7.25%, and we have our first sign of undervaluation with the intrinsic value calculated at 429. We then have the free cash flow, the discounted cash flow model, as we can see here. Average growth rate based on analyst expectations and the discount rate, the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see here that intrinsic value showing a sign of overvaluation. So interestingly, we had two signs of overvaluation, one sign of undervaluation in today's episode, and the intrinsic value arrives at $404. As always, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. Margin of safety, we jump straight in with a 10% start. We use that if we believe it has a wide moat, strong financial metrics, good forward-looking data. A lot of people will be satisfied with a 5% on Microsoft, or some even nil, depending on your own investment thesis. Right now, we see it trading at its intrinsic value pretty much $1 shy. So we see no margin of safety. Now my own strategy, as this is one I do hold, I do have an average cost around $200. So right now for me this is a little bit too high, and I would rather put that money into an ETF which does hold Microsoft. But do let me know your thoughts in the comments below. A lot of people maybe dollar cost averaging into Microsoft every week or every month, which I wouldn't say is necessarily a bad strategy. Remember, you can never time the market. It is about timing in the market. In terms of Wall Street and their forecast, well, they see surprisingly 10% upside with a price target of $443. So they do believe this to be as a buy. And as we see with Microsoft, for a long time, they do perform very, very well consistently, quarter on quarter, year on year. As always though, do let me know your thoughts in the comments below. If you enjoyed the episode, smash that like button, hit the subscribe button. We will catch you on the next one, and take care for now.